Welcome to Brainwaves. In today's video, we will explore the intriguing world of Ponzi schemes. Ponzi schemes are a type of fraudulent investment operation that promises high returns with little to no risk. They are named after Charles Ponzi, an Italian-born swindler who became notorious for orchestrating one of the most famous financial frauds in history. Ponzi schemes are designed to attract investors by offering unrealistically high returns in a short period of time. The initial investors are often paid these returns with money from new investors, giving them the impression of a legitimate and profitable investment opportunity. However, behind the facade of glamour and quick wealth lies a web of deceit and unsustainable practices. As the scheme continues to grow, it becomes increasingly difficult to recruit new investors to sustain the illusion of profitability. Ultimately, when the scheme collapses or the operator vanishes with all the funds, investors are left with significant losses. In this video, we will break down the mechanics of a Ponzi scheme, discuss red flags that can help you identify one, and explore some infamous Ponzi schemes from history. So, get ready to unravel the complexities of this financial deception. But first, let's take a look at this image to set the mood. In this section, we will dive into the early life of Charles Ponzi and his journey to the United States, which ultimately set the stage for his infamous Ponzi scheme. Charles Ponzi was born on March 3, 1882, in Lugo, Italy. As a young man, he had dreams of wealth and prosperity, which led him to emigrate to the United States in 1903. Ponzi arrived in the bustling city of Boston with only $2 in his pocket and a determination to make a name for himself. However, his early years in the United States were challenging, as he struggled to find stable employment and faced financial difficulties. Despite these hardships, Ponzi had a charismatic personality and quickly gained a reputation for his charm and ability to impress others. These qualities would later play a significant role in his ability to attract investors to his fraudulent schemes. Now, let's take a look at this image to visualize the early life of Charles Ponzi. In this section, we will explore the inspiration behind Charles Ponzi's fraudulent scheme and how he capitalized on the international postal reply coupons. It all began when Ponzi received a letter from Spain containing an international postal reply coupon. These coupons were a form of currency that could be exchanged for postage stamps around the world. Ponzi noticed an interesting arbitrage opportunity. The value of an international postal reply coupon in some countries was significantly lower than its worth in the United States. This discrepancy allowed Ponzi to exploit the difference in prices and make a profit by buying these coupons in bulk from countries where they were cheaper and redeeming them in the United States for a higher value. This concept formed the basis of Ponzi's fraudulent scheme, as he realized that he could attract investors by promising enormous returns based on this international arbitrage strategy. Now, let's take a look at this image to visualize the impact of international postal reply coupons on Charles Ponzi. In this section, we will uncover how Charles Ponzi took his inspiration from international postal reply coupons and transformed it into a full-fledged Ponzi scheme. Ponzi founded the Securities Exchange Company in December 1919, initially focusing on trading international mail coupons. He attracted investors by promising incredible returns within a short period, thanks to his supposed knowledge and expertise in arbitrage. To entice potential investors, Ponzi fabricated impressive financial statements, showing enormous profits from his coupon trading activities. His charisma and charm helped him attract a large number of investors who were eager to join the lucrative opportunity. As more people invested, Ponzi used the funds received from new investors to pay earlier investors the promised returns, creating an illusion of profitability. However, the reality was that no substantial investment was taking place. The incoming funds merely circulated within the system, and Ponzi used them to fund his extravagant lifestyle. Eventually, the scheme began to unravel, leading to Ponzi's downfall. Now, let's take a look at this image to visualize the start of Charles Ponzi's infamous Ponzi scheme. In this section, we will provide a clear understanding of the basic concept behind a Ponzi scheme. At its core, a Ponzi scheme is a fraudulent investment operation that promises high returns to investors, typically with little to no risk involved. The scheme works by luring in new investors who are enticed by the prospect of earning substantial profits. The initial investors may indeed receive impressive returns, but these are not generated through legitimate investments or business activities. Instead, the returns are paid using the funds obtained from subsequent investors. The key idea behind a Ponzi scheme is the use of new investors' money to pay off earlier investors, creating an illusion of success and attracting even more people to invest. This cycle continues until the scheme collapses, often when there are not enough new investors to sustain the payouts or when the scheme's operator disappears with the remaining funds. Now, let's take a look at this image to illustrate the basic concept of a Ponzi scheme. In this section, we will explore the key elements that define a Ponzi scheme. These elements are crucial to understanding how such schemes operate and deceive unsuspecting investors. Firstly, a Ponzi scheme offers unusually high returns to investors. These returns are often far greater than what traditional investments can generate. The promise of exceptional profits is what entices people to invest their hard-earned money in the scheme. Secondly, a Ponzi scheme relies on a constant influx of new investors. The funds from new investors are used to pay off earlier investors, creating a false sense of legitimacy and profitability. This continuous cycle is vital for sustaining the scheme and keeping it afloat. Finally, a Ponzi scheme is usually operated by a charismatic individual who portrays themselves as a skilled investor or financial expert. Their charm and charisma help in attracting potential investors, as they appear trustworthy and knowledgeable. Now, let's take a look at this image to highlight the key elements of a Ponzi scheme. In this section, we will discuss how Ponzi schemes differ from other investment scams, highlighting their unique characteristics. Firstly, Ponzi schemes are distinct from pyramid schemes. While both scams rely on recruiting new investors, pyramid schemes typically involve a hierarchy where existing members receive a share of the recruitment fees. In contrast, Ponzi schemes focus on promising high investment returns, using funds from new investors to pay off earlier ones. Secondly, Ponzi schemes differ from legitimate investment opportunities that experience fluctuations in returns. In legitimate investments, returns are subject to market conditions and can both rise and fall. Ponzi schemes, on the other hand, consistently promise unrealistically high returns without considering market forces or risks. Lastly, Ponzi schemes can be differentiated from legitimate multi-level marketing companies. While multi-level marketing relies on the sale of products or services, Ponzi schemes primarily focus on attracting new investors and using their funds to pay off earlier participants. Now, let's take a look at this image to better understand the differences between Ponzi schemes and other investment scams. In this section, we will delve into the first step of how Ponzi schemes work: the promise of high returns. Ponzi scheme operators lure in potential investors by offering exceptionally high and often unrealistic returns on their investments. These returns are typically significantly higher than what can be achieved through legitimate investment opportunities. The promise of such extraordinary profits is what entices individuals to invest their money in the scheme. Ponzi scheme operators usually claim to have exclusive access to lucrative investments or specialized trading strategies that guarantee these extraordinary returns. To add further allure, the promised returns are often advertised as being consistent and low risk, promising investors a chance to gain substantial wealth in a short period of time. The belief in these attractive returns blinds investors to the true nature of the scheme. Now, let's take a look at this image to visualize the allure of high returns in a Ponzi scheme. In this section, we will explore the second step of how Ponzi schemes work: paying early investors with funds from new investors. Once people start investing in the scheme, the operators will use the money from new investors to pay the promised returns to earlier investors. This payment process creates an illusion of profitability, as the initial investors receive the expected returns, reinforcing their belief in the legitimacy of the investment. The word-of-mouth endorsements from these early investors often play a crucial role in attracting even more individuals to invest in the scheme. However, it's important to note that the funds used to pay these early investors do not come from any legitimate investments or profitable ventures. Instead, they come directly from the pockets of subsequent investors who join the scheme. Now, let's take a look at this image to understand how the funds from new investors are used to pay off earlier investors in a Ponzi scheme. In this section, we will explore the final step of how Ponzi schemes work: the inevitable collapse of the scheme. While Ponzi schemes may appear successful in the short term, they are ultimately unsustainable and bound to collapse. The collapse usually occurs for one or more reasons. First, as the scheme grows and attracts more investors, it becomes increasingly challenging to find new investors to sustain the payouts to earlier participants. Eventually, there comes a point where the operator cannot find enough new investors, and the scheme begins to crumble. Another factor that contributes to the collapse is that Ponzi scheme operators often use a significant portion of the funds received to support their lavish lifestyles and personal expenses. This depletion of funds decreases the available pool to pay returns to investors. Furthermore, regulatory authorities or law enforcement agencies may catch wind of the scheme, investigate its operations, and ultimately shut it down. Now, let's take a look at this image to understand the collapse and consequences of a Ponzi scheme. In this section, we will discuss the first red flag to identify a Ponzi scheme: consistently high returns. One of the most enticing aspects of a Ponzi scheme is the promise of unusually high and consistent returns on investment. These returns are often portrayed as being significantly higher than what is achievable through traditional investments or market returns. While it's natural to desire substantial returns on investments, it's essential to remain cautious when encountering consistent, abnormally high returns. Legitimate investments are subject to market fluctuations and varying levels of risk, which can result in both gains and losses. Ponzi schemes, however, falsely guarantee consistent high returns regardless of market conditions or economic realities. This consistent high return is a red flag, as it is often not sustainable in the long term. The schemer relies on the funds from new investors to pay off the returns promised to earlier investors. When the new investor inflow decreases or stops altogether, the scheme collapses, leaving many investors with significant losses. Now, let's take a look at this image to understand the red flag of consistently high returns in identifying a Ponzi scheme. In this section, we will discuss another red flag to identify a Ponzi scheme: lack of transparency and a vague investment strategy. Transparency is a crucial aspect of any legitimate investment opportunity, as investors should have a clear understanding of how their money will be utilized and the associated risks. Ponzi schemes, however, operate with a lack of transparency and often provide little to no information regarding their investment strategies. The schemers may offer generic explanations or use complex jargon to confuse potential investors. This lack of clarity makes it challenging for investors to evaluate the legitimacy of the scheme. Furthermore, Ponzi scheme operators seldom provide proper documentation or audited financial statements to substantiate their claims. The absence of transparent and verifiable information raises significant concerns and should be regarded as a red flag. As an investor, it is important to be vigilant and insist on complete transparency and adequate information about any investment opportunity. Now, let's take a look at this image to understand the red flag of lack of transparency and vague investment strategy when identifying a Ponzi scheme. In this section, we will discuss another red flag to identify a Ponzi scheme: pressure to recruit new investors. Ponzi schemes heavily rely on a constant influx of new investors to sustain their operations and pay off earlier investors. As a result, scheme operators often put immense pressure on existing participants to recruit friends, family members, or colleagues into the scheme. The pressure to recruit new investors is a telltale sign of a Ponzi scheme, as the operators require a continuous stream of funds from new investors to maintain the facade of profitability. Existing participants may be incentivized with additional commissions or bonuses for each person they successfully recruit. This pressure to recruit serves two purposes for the scheme operators. Firstly, it brings in fresh capital to pay off earlier investors and delays the inevitable collapse of the scheme. Secondly, the constant recruitment of new investors helps create an illusion of legitimacy and attracts even more people to invest. If you find yourself in a situation where you feel pressured to bring in new investors, it is essential to exercise caution and thoroughly investigate the investment opportunity. No legitimate investment should rely on recruiting others to sustain itself. Now, let's take a look at this image to understand the red flag of pressure to recruit new investors when identifying a Ponzi scheme. In this section, we will explore one of the most infamous Ponzi schemes in history: Charles Ponzi and the Securities Exchange Company. Charles Ponzi, an Italian immigrant, orchestrated a massive financial fraud in the early 1920s in the United States. He promised investors extraordinary returns of 50% in just 45 days or a 100% profit within 90 days. Ponzi claimed he could achieve these remarkable profits through international postal reply coupons, which he would buy cheaply in one country and sell at a higher price in another. However, the core of his scheme relied on using funds from new investors to pay the promised returns to earlier investors. This operation gave the illusion of profitability and attracted a large number of unsuspecting investors. The Securities Exchange Company, set up by Ponzi, received a staggering influx of funds as people invested their savings. At the height of the scheme, Ponzi was estimated to be making over $250,000 per day, equivalent to millions in today's currency. Unfortunately, it all came crashing down when a series of investigative reports and inquiries revealed the fraudulent nature of Ponzi's operations. In 1920, he was arrested and ultimately pleaded guilty to mail fraud and conspiracy charges. Ponzi's scheme not only caused significant financial losses for investors but also brought attention to the concept of a fraudulent investment scheme that would forever bear his name, the Ponzi scheme. Now, let's take a look at this image to learn more about Charles Ponzi and the Securities Exchange Company. In this section, we will explore another infamous Ponzi scheme, Bernie Madoff and the Madoff Investment Securities. In this section, we will examine another notorious Ponzi scheme, Alan Stanford and the Stanford Financial Group. Alan Stanford, a Texan businessman, built an empire through his financial services company, the Stanford Financial Group. He presented himself as a successful entrepreneur and philanthropist, attracting investors from all over the world. Stanford used his company to market certificates of deposit, CDs, to investors, which he claimed were safe, secure, and offered attractive returns. These CDs were often promoted as a low-risk alternative to traditional bank offerings. However, behind the scenes, Stanford was misusing the investors' funds. Rather than investing them in secure ventures as promised, he was utilizing the money to fund his lavish lifestyle, sports sponsorships, and other personal pursuits. His scheme depended on a continuous influx of new investors to sustain the illusion of a profitable business. The Stanford Financial Group operated for several years, running vast advertising campaigns, participating in sports sponsorships, and establishing an extravagant presence to create an air of credibility. The scheme eventually came to light in 2009 when the U.S. Securities and Exchange Commission, SEC, began investigating Stanford Financial Group for potential fraud. It was revealed that Stanford had fabricated the returns on his CDs and had misappropriated billions of dollars from investors. Stanford was arrested and convicted on multiple charges, including fraud, money laundering, and obstruction of justice. The collapse of the Stanford Financial Group caused immense financial devastation to thousands of investors worldwide. Now, let's take a look at this image to learn more about Alan Stanford and the Stanford Financial Group. And that's a wrap for our exploration of Ponzi schemes. We've learned about the origins of Ponzi schemes from the infamous Charles Ponzi himself, and delved into the mechanics behind these fraudulent investment operations. Remember, Ponzi schemes thrive on the greed and ignorance of investors who are enticed by the promise of quick and effortless wealth. By understanding the red flags and warning signs, you can protect yourself and your hard-earned money from falling victim to such scams. It's crucial to always conduct thorough research and due diligence before investing in any opportunity. Educate yourself about the investment, the individuals involved, and be skeptical of any promises that seem too good to be true. Lastly, we explored some famous Ponzi schemes from history, serving as a reminder that anyone can fall prey to these elaborate financial deceptions, including celebrities, wealthy individuals, and even sophisticated investors. Thank you for joining us today on Brainwaves. We hope this video has been informative and helpful in raising awareness about Ponzi schemes. Stay vigilant, stay curious, and until next time. And as we say goodbye, take a moment to reflect on this image that captures the aftermath of a Ponzi scheme.